So I have 10 minutes to explain a little bit about the gold market, gold mining equities, a little bit of fundamental analysis, how I value this sector. I've been covering miners for 6 years. Solely gold and silver, cover 50 gold miners, 25 silver miners. I travel a lot throughout Mexico and through Canada, actually visit these mines, get to know a lot of the Canadian brokers that cover them. There's not many Canadian, U.S. Analysts that cover the industry, it's mostly in Canada. We're a little bit unique in that we do cover all these companies. So gold's always an interesting topic of conversation, so I want to share some ideas with you. Gold does well when you have negative interest rates. It used to be negative real interest rates where you put your money in the bank, get a little bit of interest, you take the money out, inflation's higher, on a real adjusted basis, you lose purchasing power. Now it's just outright nominal rates are negative. All across Europe, 40% of the yields around Europe are negative right now. In the past, when gold has done well, it's due to negative interest rates. One of the other things affecting the gold price right now, this thing called peak gold. And these charts right here by Goldco, one of the major producers, shows the discoveries right there. That's 1995. That's peak discovery. It's been declining every year since. Peak production was in 2015. It's been declining every year since. One of the other factors that's not included in this graph is the average grade per mining deposit that's been discovered. It's dropped from, I believe, about 4 grams a ton on average to closer to 2 grams a ton. The grams per ton, that is a direct correlation with cash costs, which is a direct correlation with profitability. So basically, they're finding less gold and they're finding less profitable gold. Now, that's it regarding gold. Everyone has an opinion. It's my opinion. Negative interest rates will be supportive of the price of gold going forward. But looking back, returns since 2001, it's just gold, the gold miner index, S&P 500, and treasury bonds. Now you can see the HUIs in purple, it's volatile. Gold, pretty stable. One interesting trend right here, if you look at miners versus the price of gold, this is from 2001, basically the beginning of the bull market. Gold's right here. There's a few gold miners that have outperformed the price of gold. A lot of those are the royalty companies, Franco-Nevada, Silver, Wheaton, Sandstorm, Royal Gold. There's actually a couple silver miners in there, Fortuna Silver and First Majestic Silver. But the majority of miners have underperformed gold. And this is only including, 20 companies. There's 60 or 80. Yes?
Is this price only or is it adjusted for dividends?
It's price. Dividends are small. Royal Gold pays a dividend. It's less than 1%.
If you did the chart to the peak of the market, would the miners have outperformed at that point and then they got crushed afterwards?
Yeah, no doubt. So basically what I want to show you right here that's along that thought is certain portfolios. It shows the return, annual return, standard deviation, and your Sharpe ratio. Straight up, gold's got the best Sharpe ratio since 2001. Yes, it's been a bull market. But then right here, I'm showing some adjusted portfolio. 65-35, that's stocks, bonds. 60-30 gold, 60-30 HUI. And as you can see right here, the purple line is the gold, the blue line is the blended. So it's
Garrett, what's the HUI again?
The gold miners index. Yeah. So you can see the blue line includes miners. It's more volatile, whereas the gold blended portfolio, it's more stable. It's got a higher Sharpe ratio. It did better over time. So it just has to do with your own personal investing style. If you like it slow and steady, you should add a little gold. If you like a little bit more volatility and you think you can time it a little bit better, then gold stocks might be a better option for you. But gold stocks, like I said, there's only a few good ones out there. You got to spend a lot of time doing the fundamental analysis on that, so you can do your research, or you can subscribe to us, and we'll help you.
And why do they underperform gold?
I'll show you that this upcoming slide. It's mind-boggling. Some of you might be worried about, an interest rate hike. They hiked rates in December 2015. Gold's up 20% since then. So another hike probably won't be have a huge effect. I'll get into your question in 1 second, but regarding the gold miners, that's a ton of ore basically right there. And I'm moving into more of the analysis, what a gold miner does. It's a very simple business. You mine the ore, you crush the ore, you wash the ore, that's it. So that's a ton of ore right there. It's about 2,200 pounds. That's 1 gram of gold. In that ton of dirt, there might, a decent grade would be 2 grams. There's 2 fingernails of gold within that ton. So they wash it, they get the gold out. Now, gold miner production is pretty easy to estimate because they all have mills. I use this one as an example, 3,000 tons a day mill, multiplied times a 1.5 gram a ton average grade, times 90% recovery. They get 90% of the gold out of that ton of ore. Equals 4,000 grams a day. You convert the grams into ounces, 31.1 grams per troy ounce, equals 130 ounces a day. You analyze that. So they're going to do 46,000 ounces a year if everything goes well. Right here, regarding fundamental analysis, a DCF valuation of a gold miner. Here's one right here. Lindero, Goldrock owns a project called Lindero. Fortuna Silver bought it for $101 million in June 2016. Now, $101 million, was this a good deal or was this a bad deal? The thing about the mining industry is they all produce the same thing. They all produce gold, they produce silver, they all sell it. It's not like, they compete upon price like iPhones or, laptops or anything. So it's easy to estimate, it's easy to determine the top line. It's ounces produced times the gold price or silver price. And then you subtract your cash costs. So right here is a simple DCF. This is from a feasibility. The Lindero project is not in production yet. It's a feasibility stage project, which means that they've drilled a lot of holes in it. They've got it up to proven and probable status, the ounces in the ground. Now they start at mineralized, they start at indicated and inferred, which is a drill hole every 50 meters. They move it up to measured, which is a drill hole every 25 meters, and then they step it into about every 10 meters to get proven and probable. This is what explorers and developers do. They spend a lot of money drilling, they get it to a feasibility stage, and then they can go to a bank to get financing. They either get debt or they can issue equity. So this is a feasibility stage project, and these feasibility studies are 130 pages long, if not more. A lot of information in them, but one thing they do have is a schedule which shows their average annual estimated production. It shows their all-in sustaining cash costs, which is how much it costs them to get an ounce of gold out of the ground. So you're able to, if you know those two, you're able to generate a free cash flow figure of $85 million using a gold price of $1,300. You do a straight DCF, you subtract the CapEx, and you see that the after-tax NAV is $214 million at $1,300 ounce gold. Fortuna paid $101 million. It's a pretty good deal, as long as everything goes well. One thing that's interesting regarding this too, IRR is more important than NPV to evaluate mining projects because say, you've got a after-tax NAV of $214 million. What if it costs $1 billion CapEx, for that NAV? That is not as great as looking at, a straight IRR, which gives you, 38%, which is, very high IRR. Regarding a shortcut, back of envelope NAV regarding this, instead of going through your DCF table, if you're interested in evaluating a gold miner, 1.05 the first, 1.05, use a 5% discount, 1.05 to the second, 1.05 to the third. All that multiplied out over 10 years is 5.4. So what you can do, all you can take is 2 numbers from the feasibility. You take the average ounces produced, you take the average all-in sustaining cost, you subtract the 2, multiply times the gold price, multiply times 5.4, subtract the CapEx, and boom, you got 215 mil. And it's not, you got 255 mil doing the shortcut. It's not exactly on the 215 mil, but it's close enough. It's a good place to start. So this is regarding your question, Tom. This is Newmont free cash flow, 2012 to 2016. The price of gold has, do I have the price of gold on there? I don't, but it's basically gone down over that time. 2011 was the peak. Look at their free cash flow. It went from 1.6 bill to 2.3 bill. It increased over that time. The miners are not managed very efficiently. It's just a cyclical industry. At the peak of the cycles, they're spending all the money that they make, all their free cash flow, on development and to develop new projects to keep the production going. When times are tight, they cut their costs, they stop all the production, their free cash flow increases. So I guess that's why, it's a cyclical industry, but it's a little counterintuitive because you'd think that when the gold price is high, their free cash flow would be strong. It's exactly the opposite. And miners also, man, this is like hard to believe. In 2012, 2013, they were focused on increasing production. They were focused on increasing the top line, saying, hey, our production grew from 4 mil to 5 mil. But every analyst, every person in this room would look at it and say, but you're losing more money. But the managers of these mining companies were saying, but our production's growing. So then they finally got smart and they started a metric called all-in sustaining cost, because they were only including cash costs. But you own a mine, it's an asset, you need to sink money into it. That's sustaining capital found on the statement of cash flows. You subtract that out and add back depreciation to get a free cash flow metric. The mine industry started looking at their production that way a couple years ago. So they're moving more towards a free cash flow focus, which is good for investors. Yeah, Jim.
Are there any large cap miners that have especially good management, or they kind of almost sounds like the property and casualty industry with respect to pricing, that they lose a lot of money and they kind of act in a herd fat?
They definitely
really stand out and say, like,
yeah, the industry, it's predominantly Canadians. They all know each other. I was speaking to Tom, one of the CEOs of one of the companies. They all know the analysts. They all know the CEOs. There's only so many deals out there, and they all compete for the same deals. So you get some egos in the industry, and it's like, oh, I'm not going to outbid him. But Kinross, they bought Redback for Tacius in Africa. That was like the worst acquisition of all time. It was like a $3 billion acquisition, and they never even got more than 100,000 ounces a year out of that mine. It's barely profitable, and that was all just a fight amongst Canadian to see who had the most money. It's ridiculous, And I understand why a lot of people don't like investing in these, because stuff like that happens. All right, so regarding the price of gold, and regarding the state of the industry and investing in these, over the past few years, I've started looking at these. I'm like, everyone has an estimate on the price of gold. What if, I don't know where the price of gold is going in the future? What if I just use the current price of gold and I use this to model, enterprise value and free cash and NAV on a daily basis? So right here, this is NAV on the X, EV on the Y. So basically, as NAV increases due to increased free cash flow, the overall value of the company increases, the amount of money, free cash they generate increases, their EV goes up. You see the trend line, you see the correlation right there. Back in August, First Majestic Silver, this is a decent performing silver stock. It was extremely overpriced. It was more than 2 standard deviations above its trend line right there. So you can see that. Right now it's sunk all the way back. It's got an 800 mil NAV, and it's got a billion dollar enterprise value, so it's a more fair opportunity. So what I did, this is just one example, is I took all the companies I cover. I took 60 gold companies, 25 silver companies, this chart's a little messed up. I was able to get them into a database, and the mining industry is unique because, like I said, you take the price of gold, you take their cash cost, you take their production, you know what free cash flow is going to be. You can take that free cash flow to start build a NAV calculation. You got to include all future production and estimate that, and also to get a closer picture. But then you can regress the two, NAV against EV, to figure out where the best opportunities are. This is my transform rank table. Red is overvalued, green is undervalued. One of the things that's interesting about this is, it includes my NAV analysis, like Mag Silver right there. That's one of the companies that I just visited in Mexico. They have an amazing project right next to Fresnillo. We stood on this piece of property. We looked down upon all these green fields, and Fresnillo is the largest silver producer in the world. And the CEO is like, that's where 10% of the world's silver is coming from. those fields right there of all total ever mined. And Mag Silver owns the property right over the other side. They've drilled. It's extremely high grade. Fresnillo wants a piece of it. So after that trip, I was able to adjust my NAV forecast on that company. So basically, it came back down in line. So what I'm saying is that this is quantamental. It's using fundamental analysis and applying quant statistics to it in order to figure out overvalue and undervalue, but at the base of it is fundamental analysis. And I've been able to apply, a little bit of Python. I used Quantopian platform that spoke last week, and it's an amazing tool. I do great spreadsheets, but the Python's amazing. You do stuff so much quicker. And then one of the things you're able to do is do a back test. So I was able to do, a long 10 portfolio of the undervalued, short 10 of the overvalued, and the back test looks pretty good with a low, high Sharpe ratio and low standard deviation. And then the overall portfolio, outperforms a GDX. So, I'm collecting all the data. That's the direction that I've moved in. Just, looking at, saying I'm not sure where the price of gold is going, but I do know which miners are cheap, and I do know where I can buy $1 of free cash flow for 50 cents. So, sorry about the quick presentation, but that's about it. Thank you.
Excellent.